There are certain common themes you can find in the best financial advisors. One of them, inside of the area of portfolio management, I see all the time. The trump card to portfolio design. We'll talk about that right now.
This is The Rare Advisor, proud to be a part of the Advisor Advancement Network and home of a business model supercharged by recurring and repeatable events. Your host is Mike Walters, CEO of USA Financial. He is an investment advisor representative of, and securities are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor.
Hey, there is a huge philosophical void between active management and passive management when it comes to running portfolios, either for your client, by you personally, or the client doing it by themselves. Now, generally speaking, you would assume that there is a lot more passive management taking place out there because of the huge institutions that are really behind the movement of passive management. But there are probably more active managers out there than there are passive because, again, you need more people involved to actively manage things. And it tends to be at smaller overall sizes. So in other words, the ETF for the passive tracking of the QQQ for the NASDAQ 100 or for the S&P 500, those are just monster size mutual funds, monster size ETFs. The actively managed stuff can be big, obviously. There's exceptions to every rule, but as a total, they tend to be a little smaller in size. So one could argue that where is the marketing money coming from versus, pushing the concept of passive, pushing the concepts of active. Then there's just philosophical changes and differences on what you think. Now, I tend to lean a little more towards active. I want someone monitoring and taking control of that situation because I don't want to just ride and coast through the next financial crisis. And when you're on the passive side, the argument is, well, yeah, but the active advisors, they never, can time it correctly and so on and so forth. And you're better off just staying still. And so you can fall in whatever camp that you like on that. Now, there are times when it moves, which is what we're going to talk about in a moment. And after the financial crisis, a lot more money kind of moves towards active. And once things are hunky-dory for a long enough period of time, things start going back towards passive, which is what's kind of going on right now. And I'll show you these numbers here, but what I really want you to think about is risk management. So I kind of talked about active management as if it has a risk component. It doesn't always. That's what I mean. So really, there's almost a third category. There's risk management. So whether it's passive or active, I want to know if somebody hits the alarm, we can move out of equities, for example, and I can sidestep things like the financial crisis. So there was a bunch of study that just completed here from Sorelli Associates and looking at Morningstar Direct information. I just printed this one simple chart because I want to show you how close this is. Look at how neck and neck. This is total active. Doesn't matter whether it's funds or ETFs, total active. This is in millions. So 13 millions of dollars sitting in active management. Passive management, 13 millions of dollars sitting there as well. They're almost an identical number if you check that out. But look what's happened here in 2023. In 2023, we had a huge negative outflow from active and a huge positive inflow into passives. Again, the market's been doing really well. When the market's doing well, that's what happens. So there's a thought that you need to have as a financial advisor, and you need to understand. You need to understand this, especially if you tend to lean more towards the passive camp. And that is that when people get sick, that's when the doctors are needed most, right? When people are healthy, they're not calling their doctor just randomly because they want to chit chat. When people get sick, that's when they go to the doctor. When markets crash, that's when people need financial advisors. That's when people need active management. When the sun is shining and everything's hunky-dory, passive is just fine. I'm perfectly healthy. I don't need to go see the doctor. But when things aren't so good, that's when you earn your keep as a financial advisor. So regardless of whether you want to fall in the active camp or the passive camp, what I will contend is consider risk management. Whether that risk management is laid atop passive or laid atop active, What you really need to focus on is risk management, because that's when the people get sick that we want to make sure we have the cure, that we have the proper medicine. So consider risk management. We run a TAMP program. We've got all kinds of different strategies from all kinds of different asset managers on there. But again, the most popular stuff in there tends to be that which has good risk management.
This information is for licensed financial professionals only and is not intended for use in soliciting sales from the public. The views expressed represent the opinions of the presenter or their featured guest, not necessarily those of USA Financial or its affiliated subsidiaries. Industry references are generic and not intended to represent actions or beliefs of any individual or entity. Content is only presented to illustrate general principles, beliefs, or ideas and should not be construed as legal or regulatory advice. Trademark and copyright protected. USA Financial and Affiliates.